Good afternoon, everybody, and welcome to the Wednesday Lunchtime Drive-Through. Today on Wednesday, April the 26th, my name is Damon King. I'm a certified financial planner professional and wealth manager with ChappelWood Financial Services, and I'm also the lead instructor for ChappelWood University, which is the educational branch of ChappelWood Financial. Today's topic, investing in a real estate fund. Real estate is one of those assets that everybody dreams of, everybody thinks about. In fact, I probably get asked more about real estate than I do gold. Gold was the big thing, but people ask about real estate all the time. Should I invest in real estate? And many of our clients here at ChappelWood Financial have real estate in their portfolio. And owning real estate is very common among millionaires, generates cash flow, appreciates in value, usually, okay? It's relatively easy to sell or trade, and we're talking about if you own the actual buildings, if it's a rent house, an apartment complex, condo, that sort of thing. Usually you're able to pass it on to your heirs. But as you all know, there is no investment, there is no asset class that is perfect. There are advantages and disadvantages to every investment that you make, and real estate does present some downsides for investment. Some of the risks associated with that. Number one, it's capital intensive. It takes a lot of cash usually to buy a house, or if you want to buy a multifamily unit, it could be in the millions, all right? You're going to have maintenance, taxes, and insurance that you have to pay. Dealing with renters. Do you want to be a landlord? All right. Sometimes it's a hassle to sell. Maybe the market's not good at that time. Maybe interest rates have gone up like they are right now and priced a lot of the people out of the market. And it's sometimes just time intensive finding the right property, especially if you want to do a 1031 exchange. You want to exchange one property for another. There's a very tight window for when you find that property. So even if you hire a property manager, being a landlord is not for everybody. You've got to have the Constitution for it. All right. So there is an alternative. There's an alternative to actually buying the real estate for yourself. And that's what we have our special guest on for today. So I'd like to introduce to you Mr. Joseph Kimbrough. He is the CEO and founder of Apex Real Estate Investments in Dallas. And Apex is a real estate fund. It's a real estate investment fund. Now, Joseph, I hope I got this right. You're a veteran of the U.S. Marine Corps, is that right?
Yes, I am.
Okay, so
I did 4 years.
4 years in the Marine Corps. So right here in front of God and everybody else, I'm going to say thank you for your service to our nation. It takes courage to do that. I never had the courage to join the military. So to you and to all of our other veterans who are on the call, the men and women that serve, thank you so much for that.
Thank you, and you're welcome.
So this show is yours today. So before we get into our questions, ladies and gentlemen, as always, I want to remind you that you can ask Alex, or sorry, not Al. I looked at Apex and I was going to say Alex. You can ask Joseph any question you want today. And if you've got a question, please use the chat or Q&A button down in your toolbar. And once you submit that question to Joseph, then I will share it here and he will answer it. But Joseph, I really want to start by just really quickly, the Cliff Notes version. What is a real estate fund?
So Apex Real Estate Investments itself is actually a privately held equity investment firm. So it's what I put on social media, because I don't necessarily advertise it as a fund, because it takes accredited and non-accredited investors. But a real estate fund is where you're able to buy shares of the fund, and then you own a part of every property that the fund acquires. So let's say that particular fund acquires 500 to 1,000 units, then now you're getting paid from 500 to 1,000 units with a minimum investment of, let's say, 100,000. And for some people, they even invest 250,000.
So then it stands to reason, if you are investing in the portion of the ownership of that piece of property, then that also means you get to benefit from any income. that comes.
Exactly. You benefit from income, you benefit from the tax advantages. We provide Schedule K-1s for you every year. You get monthly reports. I just sent out 2 reports a few days ago. Each one had over 100 pages of very detailed information, so you know every single thing that's going on with the property. So we're extremely transparent as well.
Okay.
Also, so yes.
Yeah. So that's kind of what a fund is, and I think most of our, because of the clients that we have here at ChappelWood Financial, and all of those who attend our Wednesday lunchtime drive-through are pretty savvy investors. They understand what a real estate fund is. But one of the questions we get right now is, real estate still a good investment? I mean, isn't the market starting to cool off? We know that it was hot and heavy, and we've actually got some real estate professionals on the call today, so they may have some thoughts about this as well. But what are you seeing? Is real estate still a good investment?
So what me and my partners have been talking about is real estate is a great investment for this time because, as you know, inflation is rising, they're raising interest rates, and particularly real estate provides a hedge against inflation, especially if you're investing in multifamily apartment buildings that have 100 units or more, that like what we invest in. Uh, Also, to go more about the market, it also has the effect where when interest rates are rising the way they are, it squeezes some newer operators who may have gotten variable interest loans. Uh, so depending on the kind of debt that they got, it can affect them and result in deferred maintenance, which then for experienced operators creates an opportunity for them to acquire more property at a discount. So
Yeah, and that's interesting what you're saying. So for example, most of the properties that you're investing in, are people renting those from you, or are they actually buying? They're renting basically.
yes, these people are renting. They're apartment buildings, like
That's
your
right.
big 100 unit plus apartment buildings.
So
Yep.
it's all rent. And so there are a lot of people right now, especially in bigger markets like in Dallas, where you're at, and where housing prices have just gotten sky high with rising interest rates. They may not be able to afford a mortgage at this point. So
Yep.
their only other option economically is to rent, which I guess would make it more attractive to invest in some private real estate holdings, things like that, where you're deriving income from rents.
Yes, I'm glad you said that also, because also with home prices rising and the debt being more expensive to get, people have no other choice, but people have to live somewhere. So they have no other choice but to go stay either in apartment buildings, maybe they can go to a condo, they can always go to a mobile home, but they're going to choose apartment buildings most times than not. That's typically the next level that they would go to.
Yeah, absolutely. I've got a couple comments that came in here. One comment and then one question. Doug is a real estate professional. He's a realtor here in the Oklahoma City area, and he says the best time to invest in real estate was 20 years ago. The second best time to invest in real estate is today. So
It's today. Yep.
I
I
like
like
that.
that.
All right, so now this comes from Jay. Now, Jay is one of our really savvy clients here at ChappelWood. And I like Jay. I appreciate you're a gentleman, because he says ahead of time, Damon, this is loaded. This is a loaded question. So
This is a loaded question.
I'm gonna pitch this to you. What would cause a private REIT to drop over a 10-year period, a 44% drop over that period? So what would cause a REIT, whether it's a private REIT, to drop 44% over a 10-year period? What do you think?
That's a really loaded question. A really good question. So, this is not a REIT. What I operate. This is a 506B fund that takes non-accredited and accredited investors. So you're actually buying shares of a private fund, and meaning you get access to their real estate. A REIT is different, actually. So a REIT, you don't, from my understanding with REITs, you can actually lose pretty big in markets like this. From my understanding of a REIT.
So what do you think? I mean, do you think that could be just a function of the management? choice of the properties that they're choosing? You know, I
I
mean,
would say I would say one key difference is that with a REIT, you're not able to take advantage of the tax advantages from the real estate like you are with a fund. So with a fund, you get the bonus depreciation and the cost segregation. You, as a passive investor, get to take advantage and share into that. But as a REIT, you're not able to do the same thing. Now, don't quote me on that. I don't have 100% understanding of how REITs operate, but I can tell you the fund is different.
yeah. And and I can speak somewhat to this, Jay. Also, I think I think it depends upon the kinds of properties that the REIT is investing in. You know, we go back to COVID. When COVID hit, the office space got decimated because a lot of businesses shut down. They went virtual. And so they didn't need to rent their office space anymore. And so we saw clients that sold office buildings because they didn't have any tenants anymore. But we also saw REITs that were suffering because their rents were down. People were not able to pay rent anymore, or if it was a mortgage backed type of security, people weren't able to make their mortgage payments anymore on the office side. However, residential and industrial still did really well, especially industrial. People were buying warehouses. Why? Because people were buying more stuff online, and you started seeing more of these companies needing space to store their stuff, their inventory. And so I think it depends upon the kind of real estate that that particular REIT is investing in. But what could cause it to drop over 44% over a 10-year period? Well, that's a lot of bad bets, I think. You know,
Yeah.
I would want to see, to me, the only way it would drop 44% is if they're just really maybe poor management, and really making really bad bets on the kind of real estate that they're purchasing. So I don't know.
Yeah, but I feel like I feel like a REIT is more like it's closer to a stock almost. Am I correct?
But yeah, I mean, a private one probably it's like a stock. Yeah, it trades like a stock. There are public and private ones. But this would be a private REIT, probably a closed-end type of fund, that sort of thing. Um, Lynn has another question here, another one of our great clients. She's asking you specifically, Joseph, does Apex only buy in the Dallas area, or do you own homes and multi-unit apartments, or just apartments? So it's two questions. Do you only buy in the
Okay.
Dallas area? And do you own homes and multi-unit apartments, or just apartments?
Okay. Yes. So we only invest in apartment buildings that have 100 units or more. Typically, we're investing in stuff that's between 100 to 200 units, and we invest in Texas, all over Texas, and then also the Southeast markets, such as Florida, the Carolinas, Georgia, Alabama, Louisiana. So we invest in all those markets as well, all landlord-friendly states, because we want to make sure our investors get paid.
Absolutely. Everybody wants to get paid. Let's go to another question here. What are the pros and cons of investing in a fund, not a fund, but investing in like private equity like you're doing versus actually owning the property? So let's first start. What are some of the pros of doing using an investment kind of like what you do
So the
versus
pros
actually owning
is,
the property?
yes. So the pros is, one is truly passive income because you're not having to deal with any of the tenants, toilets, trash, none of the stuff that you normally would have to deal with uh, owning a property outright yourself. Also, by investing within a private equity fund like the one I have, you are able to invest in more properties. So your money is more diversified, which creates better opportunities for you to win. Also, by investing into this fund, on all of our properties, we do a 10% downside performance protection hurdle, meaning at the time of sale for any one of our properties, if it was to underperform, then we pay our investors a minimum of 10% annual return on investment before we take a profit.
But that's only
So that's a
that's
pro.
that's when you sell the property, not
That's
when.
only when we sell though.
Okay.
That's on the sale.
And
We're not
it's
going to do that
something,
yearly.
yeah, exactly, right? I mean, 10% guaranteed
Yeah.
return every year. Who wouldn't want to take that, right? Actually, something you just said made me think back to Jay's question. So another thing, Jay, that could potentially cause a private REIT or really any REIT to fall that much in that long a period of time, maybe they were highly concentrated in just one type of property, or maybe even just
Mhm.
one property. It's no different than if you have a portfolio and you're highly concentrated in one stock or one
Yeah,
industry. You can see wild swings that are totally uncorrelated to the rest of the market if you're too concentrated in one type or one specific investment. All right. So I said earlier, no
exactly.
investment is perfect. So what are the downsides of private equity versus owning the property outright?
I would say the downside to private equity is your your return on investment isn't necessarily as high as it would be if you owned the property yourself outright. Like, let's say you went and you paid 100% cash for an apartment building. Few people can do that, but if you have the luxury to do that, then your returns are going to be crazy. They're going to be high. So that I would say that's one of them. As far as a con as well, uh, I would say it's kind of like a blind pool. So we invest in different operators. I know my fund particularly, the way I do it is I invest in different operators who have a strong track record. But not every fund operates like this. Some might invest in new operators. But I have a strict criteria of who I invest with. You have to have 20 years of experience and own over 10,000 plus units already before I would park investor capital with you.
Yeah. Yeah. I mean, I guess one of the cons is that you're relinquishing control of the choice of assets that are being purchased to the private equity fund, right?
Yes,
You're
exactly. And
whereas,
so you're relying on
yeah,
the experience of the operator that's in charge versus your own experience. That is the
yeah,
only con. That's one of the cons, I would say.
yeah, and may or may not be a con, but it is a potential weakness. I mean, I have to be honest, it's no different than if you hire an advisor to manage your stock portfolio versus you doing it yourself. You've got more control over it. You may have differing opinions to the advisor, and that might cause you to do different things. So there are always pros and
That's true.
cons to any investment opportunity. Again, ladies and gentlemen, if you have a specific question for Joseph about real estate investing, if you've thought about jumping into real estate, but you're curious about should I buy a building or should I just invest in a private equity fund or something like that, this is the time to ask that question. Here's another question that I have for you, Joseph. A lot of people, the kind of the litmus test for how does an investment perform, people compare it to the S&P 500. Okay, now
Mhm.
there are reasons why I think that's a bad idea to always use that, but let's do that. How have real estate funds like yours, private equity, performed compared to the stock market? Is there a correlation there, or is it totally uncorrelated at all?
So I would tell you that for my particular fund, the sponsors that I work with that manage the properties, they average for exited projects annual return on investment of 29%, which is definitely outperforming the stock market.
Absolutely, yeah.
And
Yeah.
so then that's on properties they went full cycle with. They bought and sold already over 20 something properties over their 20 years of being in business. And that's what they've averaged. When you factor in the cash flow, when you factor in anything they did from like a refinance, and then also even selling the property outright and paying the investors uh, the lump sum.
Yeah. Is there
So I
any,
would say that we've outperformed the stock market.
okay. And is there any correlation to the market, the stock market, to the real estate market? I mean, do you see when the market's volatile, do you see similar things? For example, one reason people pitch Bitcoin all the time is that, or cryptocurrency, well, it's totally uncorrelated to the market. That's a load of you know what. It's
Yeah.
totally correlated to the market because it has been volatile right along with the market. You can overlay those charts on top of each other, and they're moving in almost the exact same way. What would you say is the correlation of real estate to the stock market?
I would say, as far as correlation, when the stock market, when inflation is rising, the stock market typically does not go in the same direction. It suffers. So the correlation between the two would be that real estate hedges against that inflation. So when interest rates are rising and stuff, then it's better to move your money into real estate to hedge against that inflation. Now, if you want to still keep some money in the stock market, so be it, because it is more liquid than real estate.
Yeah, and I'm glad you say that because we never advocate for putting all your money in one bucket, right? You want to spread it around, and the key
Yep.
is balance, particularly for the vast majority of our clients who are either very near retirement or already in retirement. We did have
Yep.
another question come up here from Doug and Jennifer. What happens for investors if a property in the fund is destroyed or damaged?
Well, that's an insurance thing. If it's destroyed or damaged through a tornado, hurricane, something like that, then insurance would cover that.
And then would the investors receive a portion of that claim payment?
Yes.
Okay, so they would be,
Yes. We
they
always
would
make
be,
sure our investors get paid.
okay,
Yep.
all right.
That's number one priority.
Okay, there you go. There you go. And your investors are getting paid before you guys are getting paid, right?
Exactly.
So, you know, we've got a lot of people on the call today, and maybe they're considering private equity or just some kind of a real estate investment like this. What are some of the things that you would encourage them to think about before pulling the trigger on something like this?
I would say think about how much you want to allocate towards real estate because it is considered an alternative investment. Um, I would say you should at least have 20% of your portfolio in alternative investments. And it doesn't all have to be real estate. To your point where you like, you don't advocate for someone saying, hey, only invest in this one asset class. The only person I would recommend something like that is a wolf in the hen house. So they just trying to get a quick buck, man. But yes, so things to consider, consider definitely the operator that's going to be over it, the experience level. And that's why I work with the operators that I work with. They have substantial experience in real estate. They've survived 2008. They've had their ups and downs. They've seen things. They know how to move forward even in this market.
Okay. Very good. Let's see. Do I have any other questions? Okay. So, ladies and gentlemen, I since we got started a little bit late, I'm going to give you 5 more minutes here. So, I again thank you for being patient today and sticking with us. I want to open up the floor here in the last few minutes for any other questions that you might have for Joseph. This is the time to ask. We appreciate the questions that have come in so far. You know, while people are submitting their questions, Joseph, tell us about what's been your best investment and your worst investment so far.
Let's see. Well, I'll start with my worst investment. My worst investment is when I got started in single family years ago, and I was doing what's called wholesaling. I'm pretty sure your people would know what that is. It's where you're cold calling people to get properties under contract and then you sell them. The reason why I consider that my worst investment is because I sold over 20 some properties in like 1 year and had no property that I owned myself. I didn't own anything myself. So I just sold off equity. So I consider that a horrible investment because you only just sold off equity, you didn't acquire anything for yourself. Best investment was within the first year of starting this fund, acquired 160 units in Charleston, South Carolina. And so that's been my best one so far.
Okay. Very good. You know, I have never been to Charleston, South Carolina. I hear that it's beautiful and that it is really Just a wonderful, wonderful little community, well, city, and it still has that old South charm to it, is what I've heard. So let's see here. Ladies and gentlemen, are there any other questions that you would like to ask Joseph today about private equity, his thoughts on the real estate market? Are you thinking about getting into the real estate market, any kind of private equity or REIT or anything like that? Please go ahead and submit your question here. We've got just another few minutes that will stick around. So Joseph, tell us, if somebody wanted to get in touch with you, how do they go about doing that?
So you can reach out to me, send me a text message to 469-540-5031, or you can also go to my website, which is investinapartmentsnow.com, and then you can schedule a call, and there's also a PDF on there that goes over the 10 benefits of investing in multifamily.
Yeah, and keep in mind, ladies and gentlemen, that when we have guests on like Joseph, this does not represent an endorsement of Joseph's fund versus anybody else's on the part of ChappelWood. So that I want to make sure we get that out loud and clear. Just like with any investment, we will want to make sure that if you're considering putting money into it, that it meets your goals, it meets your risk tolerance, and that it checks all the boxes. However, we do like to bring opportunities to you so that you can see what's out there that is beyond just the typical stock market. So it looks like we do have okay, so Bill asks a great question. Joseph, what is the minimum investment amount?
It's $100,000.
$100,000. Okay.
Yes.
Simple enough. Simple
And
answer.
you can use a self-directed IRA also, cash, or you can use retirement funds.
Okay, so if you've got the fund can be held inside of an IRA or a self-directed IRA, something like that.
Yes. Like if you set up a self-directed IRA, you can invest that into the fund as well as cash.
Okay. Well, very good. All right. Well, Joseph, I don't see that we have any other questions for today. And I want to thank you very much for being our guest today. Again, we got started a little bit late, but we still had a lot of great information, and we appreciate you joining us for the Wednesday lunchtime drive-through today.
Yep. Thank you. I'm glad to be on.
All right, ladies and gentlemen, thank you for being on today. We hope that you enjoyed this conversation. And of course, if you've got any questions, if you want to reach out to Joseph, you certainly can. Or if you've got questions and you want to forward those to me, I will certainly forward those to Joseph. You can contact me at damon@chappelwood.com. You can also text or call us at 405-348-0909. And we'll be happy to do that. And until next time, I want to say enjoy the rest of your week. And also just to let you know, through the month of May, we are scheduling strategy meetings for many of our clients. And so, as I always do, the Wednesday lunchtime drive-through will be on a hiatus throughout the month of May. So that means starting next week, and then all through the Wednesdays of May, we will not be hosting the Wednesday drive-through, so that I can take time to meet with clients and take care of them and prepare for those appointments. We'll be back in June for the very first Wednesday of June. So enjoy your month of May, and I'll see you in summertime or close to it. Take care. Bye-bye.